Existing home sales falling 2% in September, hitting the lowest level since October 2010. Median existing home sales prices also marking its third consecutive month of year-over-year increases. And while mortgage rates continue to approach 8%, further impacting affordability. Here with more on what's ahead for potential home buyers, we have First American Chief Economist Mark Fleming. So, Mark, we kind of know the setup here, right? So on supply, we hear limited inventory, Mark. I mean, I'll tell you, here in New Jersey, where I live, Mark, it's basically no inventory. Then on the demand side, affordability has just been crushed. I'm actually looking at 30-year fixed, Mark, ticking a little bit above 8% here, according to Mortgage News Daily. Given those dynamics, Mark, where do we go from here?
Yeah, this week wasn't nearing 8%. It was surpassing 8%, and that was prior to today's moves. And so just what we were listening to in the last segment clearly is indicating that there's a lot more upward pressure to put mortgage rates above 8. But to your point, mortgage rates today actually impact both sides of the market. There's the obvious affordability crunch, makes it more expensive to get a loan and buy a home. But at the same time, since so many individual existing homeowners locked into such low rates, just a couple of years ago, they are not incented to sell. And so low inventory, even though there's less demand, and we still see rising prices.
I just keep reading the figure, Mark, that existing home sales are at the lowest since 2010. It feels just absolutely frozen out there. Is that how you would characterize it? And doesn't seem like anything's going to change anytime soon?
Yeah, 2010 was, the height of the global financial crisis. If you take the global financial crisis time period out, the last time we had home sales at this level was back in the late 1990s. So, getting below 4 is a rare event in modern, housing market history here in the U.S. Since, if the pandemic were the best of times for housing, then these are clearly recent worst times. And Fed's saying it like we're going to keep it higher for longer. Higher for longer means the disincentive for those existing homeowners to sell is going to continue to be there. So it's hard to see how it changes anytime soon, meaning anytime in the next 6 months to a year. In fact, your prior guest was talking about when was the Fed likely to cut rates again? Probably not until 2025.
And Mark, you mentioned there that we're still seeing these rising prices. Do you expect that to change, Mark? You see that breaking anytime soon?
I think the more that rates have risen in the last couple of weeks and are continuing to rise, there's sort of more anecdotal evidence of further price softening because the demand side is really sort of catching up with the lack of supply. The months of inventory is ticking up a little bit, and that's the dynamic of even though there aren't many homes for sale, there are fewer and fewer people out there buying homes because rates are so high. And that's going to sort of slow house price appreciation a little bit more. I mean, we went from house price appreciation in the 10 and 12% year over year range to now, according to our index, of 5 or 6%. We could even see a little more softening, but it's hard to see big declines in house prices, just even slower growth.
Mark, can you talk to us about the bigger implications for the U.S. economy here with the housing market in this kind of shape? I mean, when you're looking at the GDP now forecast for 5.4% this quarter for growth, I mean, that seems pretty good. Last quarter, I should say. But is that baking in all of this lack of activity on the housing front?
Yeah, the housing market is a significant contributor, obviously, to overall economic growth. But the truth is, buying and selling of an existing home doesn't necessarily add too much economic activity other than real estate commission fees and things like that, or that we all like to go and buy new furniture and housewares when we buy new homes. And those segments of the market are certainly being impacted. The mortgage industry itself is certainly being impacted because not only are home sales down, but refinances are practically non-existent. But otherwise, we're not so large a component of the U.S. economy that we're a huge drag, although there is certainly a drag to less economic activity around the buying and selling of homes, particularly found in places like furniture sales.
And Mark, I'll get you out of this here on this question. I'm just interested to get your take on the rental market, Mark. What do you see ahead there in, let's say, the next 6 to 12 months?
Well, there was a benefit over the last couple of years in that since it was so hard to buy a home, then sort of people were remaining renters, even though they wanted to be home buyers. And the multifamily building industry responded by bringing along lots and lots of multifamily starts. Now, household formation has slowed down, and there's less demand for rental relative to the heights of a year or two ago, and vacancies are rising. So the multifamily market is softening, and in many places, rents are coming down from the highs. That's mostly driven actually by a slowdown in new, young Generation Z households forming.
Mark Fleming, great to get your perspective on this. Hopefully things start to pick up a little bit, but we'll see. Thank you.
Thank you.